Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler along with Mr. Ira Work. So, if you are a student of the market, don't watch it too close because it's nothing, but it'll drive you crazy watching it too closely. But we'll just talk a little bit about what has been happening recently. If we look at the month of, I guess it was July, markets didn't matter which market you were looking at. They all looked pretty good. And I mean, sometimes I go, which market, when somebody says the market did this, and I go, which one? Because you got large U.S. stocks, you got small U.S. stocks. There were market segments that had significantly different returns in the month of July. Some areas did much, much better than others. But, in general, all different markets, whether they be large, small, value, growth, international, U.S., all pretty good. August, not so much.
But, the reality is that when people say to me, well, the market's not looking good, or the market did great this month, or I don't know what I think about the market, they're referring to three different U.S. benchmarks. They're not thinking as globally nor as diversified as we are by actually breaking them down even further to growth and value or large and small. Mm-hmm. So when they hear the market, for the most part, most people are actually thinking about the Dow.
Yeah, and the other two.
And the NASDAQ and the S&P. Mm-hmm. So maybe the S&P a little bit more. But I think most people, their investment knowledge is limited to what they hear on television or radio.
And in general, that's going to be true. I can't remember last time I heard somebody come in here and say, hey, I heard the Nikkei did this, or the EFA, the Europe, Australia, Far East Index did this. So most people don't really know a whole lot about that. So in effect, that's what we're talking about. If we look back through history, it's a pretty significant historical difference between value and growth companies. Value having the higher return, growth is being what you hear about more often. So that it's been one of those things that we've looked at in July. You had really good. And then what happened with August was that there had been some talk about the Federal Reserve, about interest rates, and companies that are going to be more affected by increasing interest rates would be who? Well, it'd be companies that borrow money more often. Companies that don't need to borrow money are not going to be as negatively affected. Also, companies who don't necessarily rely on the public borrowing money to buy their products wouldn't be as negatively affected. So let's say if you have to borrow money, maybe for cars or for big ticket items, you are going to be less likely to go buy the products of companies that make stuff that you have to borrow money for if interest rates go up. So hence that has been one of the things that has been talked about pretty significantly. Now, this past week, Fed chairman, so the Federal Reserve, they are an independent bank, and people say, oh, it's unconstitutional. I hear all kinds of stuff. Conspiracy theories. You're not going to hear conspiracy theory garbage out of me. But in general, you have a separate entity that deals with the money supply. For example, why is this important? Well, if you look around the world and you look at how big of a problem our debt is, compared to other countries around the world. Look at our national debt. You hear an awful lot of people talking about how our national debt is going to sink us, and people worry. They go, it's going to also affect negatively companies as well. And people own the stock market. They think it's negatively going to affect the stock market. And one of the things I point out about this is that if you're talking about a company, why is it, and this is my question to you, why is it that a stock would go down in a company, or the company would be negatively affected by a debt that is owed not by the company, but by the government? Okay, so think about that for a second. Why is it that the company would be affected? And you could make the case that if the government is in a negative cash position, they've got a problem, that they may raise taxes on companies in order to collect money, in order to tax these corporations, and therefore that will negatively affect the earnings of the companies, and that would drive the stock market down. But you have a serious problem with that theory. And that is that companies will pick up their toys and leave. Think about Burger King leaving, the one example I always like to give because it's such a stark example, picking up their toys and going to Canada. Or think about Warren Buffett basically saying, here's what companies do, guys. They borrow money from each other, and thereby they don't have to pay taxes. So they find ways to get around the taxes. Okay, that's one of the things that they do. Or they go and change where they operate out of. Maybe they move their operations to other countries. Now, politicians know this. How do I know that politicians know this, Ira? How do we know that politicians know that companies do this?
Because they get on TV and talk about it.
Yes. And what they do is they put all kinds of tax benefits in force if you will move to their location. You know, notice that when companies think about moving their businesses, a big corporation's thinking about moving where they're going to manufacture cars. What gets in the news everywhere?
Where Ford is moving.
And what are the politicians doing? They are coming up with all kinds of tax incentives to get people to move to their location.
Right.
So you think about this, politicians know this. They know that if they tax a company too much, that the company will locate someplace else. So if the government's problems, follow me on this one, if the government's problems are somehow going to negatively affect corporations, because that's what people are worried about, right? If the national debt gets too high, the government will tax corporations to death and the stock market will go down. So you think about what is going on here. This is basic psychology. Basic psychology is where something negative or something scary is brought up in the media. And then there's the middle part of your brain that responds to new information in 0.2 seconds versus the front part of your brain, which is the thinking part of your brain, and it takes a lot longer for it to respond. Then what it does is it drives you to make a decision that many times is irreversible and make a mistake. And we're talking about an investing mistake when we go and change our portfolio based on something that scares us. Now, this whole idea of the national debt getting out of hand is not new. When I was an economics major over 30 years ago, we were panic-stricken over the national debt. Let me just tell you. If you look at the national debt and you look at it as a percentage of GDP, it is very, very high. No question about it. It's a fraction of what Japan's is. And it's a fraction of what some other countries are as well around the world. And you look at Germany, you look at France, you look at a lot of countries. And when I'm talking about these other countries, their stock markets, even with higher GDPs or higher debt compared to their GDP, that's how you measure debt. You measure it compared to the economy. Even with very, very, and even higher debt to GDP ratios, their stock markets have done just fine over the past 30 years. Okay, so I'm not dismissing the debt and saying it's not important at all, nothing like that. I'm just saying that is something that people have talked about negatively affecting the stock market for quite a long time. So the Federal Reserve, and some people have said this, and I've even quoted this before because the people will say, hey, what we could do is we could print our way out of the debt, right? Mm-hmm. And there's that talk. There's the talk. We could print our way out of the debt. We could increase the money supply. Now, did they do that? Maybe a little bit, but they don't overdo it because the reality of it is the Federal Reserve is big on making sure that inflation doesn't get out of hand. And if inflation gets out of hand, and because the Federal Reserve is separate from the government, and that's one of the people say, well, it's not even a government agency. It's not even the government. Well, we don't want it to be. And the reason is we want a separate entity controlling the money supply. And by the way, other countries around the world, all the major economies around the world have their own central banks. And that's why they have their own central banks, is because we want that to be a separate entity. Because if you had government officials in charge of it, let me tell you what would be happening. Hey, it's election year. Let's increase the money supply so we get the economy rocking and rolling. And then once they get elected, they let everything go to heck in a handbasket for a couple of years. And then just before election comes up again, hey, let's increase the money supply. So, so you would have politicians rigging the process. So that's number one. That's why we don't do that. And I hear all kinds of people saying, oh, no, that's not the way it works. It's the way it works. So in effect, what happens is we have this control over the money supply. But there's another thing. And it was interesting because actually Trump talked about this when he was president, the possibility of taking national assets and selling them to pay off the debt. And, a lot of people forget. And, I say that laughingly, but, there are a lot of national assets that you could use to pay off the debt and pay it down some. So I guess it's out there. It's a possibility. But if we look at the national debt, number one, it is... A lot of people use that as an example of, why we have to be, very, very concerned about stock markets. And the issue is this. Do companies have to pay to use your money? Just because the government has a lot of debt, does it mean that they will no longer have to pay to use your money? In other words, will stock market returns go away just because the government has a lot of debt? No, actually, if you have lots of inflation, companies will keep charging more for their things. And historically, what happens, their earnings go up because you keep having to pay more for the stuff that they're selling you, and actually could be really great for stock. When you look at some of the highest stock market returns in our history, it's been in much, much higher inflationary periods in the nation's history. So, it doesn't necessarily equate that just because we have inflation that you have bad stock market returns. So what happens is that the Federal Reserve comes out and talks an awful lot about inflation and interest rates. And hence, that's the reason. So it can have a negative impact on earnings in the short run, and hence stock markets go down. But don't necessarily take that to mean that stock markets long run will have bad returns, because that's just absolutely... That doesn't equate. So the Fed actually came out this week and they were talking a little bit about this. And here's what they had to say. Here's what Fed Chairman Jerome Powell had to say about this.
We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate, and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. We are attentive.
So in essence, what he's saying is that we could be raising rates, and this is something the Wall Street Journal took some issue with. And they were editorializing on, because they're looking at this and saying, is this really true that the Fed will continue to raise rates? Because there are a lot of things out there that are telling us that interest rates may not need to go a whole lot higher, simply just because there's weakness that's showing up in various places. But the Fed chairman is saying and talking about interest rates going up more preemptively, is what the Journal says. They're saying that, he had this on the one hand and on the other hand speech that he gave. On the one hand, the unwinding of the pandemic distortions, with supply chain issues and all those types of things, and the Fed rate increases are now working together to bring down inflation. So that's what the Fed chairman is saying, is inflation, the pressure is downward. And if the pressure is downward, that would mean that you're not necessarily looking to increase the interest rates anymore. But then there are some hawkish sounding aspects, which is where he's saying we might have to raise rates in the future. And a lot of people are looking at it going, well, shoot, housing's slowing down, quite a bit. Car purchases have been slowing down quite a bit. But the reason that the Fed would continue this type of talk is, in essence, what they're saying is because we don't necessarily want to say, hey, inflation's no longer a problem anymore. Because all of a sudden what that would do is that would start causing stock markets to go up. That would increase the wealth effect maybe a little too rapidly. And when you have the wealth effect, which is people feel wealthier when their investment portfolios are more valuable, and when their homes go up in value and their businesses go up in value, what do? They spend, and thereby bring inflation right back to the forefront again. Mm-hmm. So the Fed, by just being a little bit hawkish, is just saying, hey, don't get too out of hand. Don't get too big of a rush. And we may actually come back with some rate increases in the future, so don't necessarily get too optimistic too soon. But they don't want to spook investors. And so what happened is the stock market, when he first made those comments, this is the nature of market efficiency, by the way. Markets digest new information as it comes out. And when he started coming out with hawkish talk about increasing interest rates, stocks started to slide down a little bit. But then what happened is more people started to think about what he was saying and how he was saying it. And it started to sound like he was going to be very careful and that he wasn't in a rush to raise interest rates. Stocks actually started to increase again.
Right.
And you had to know ahead of time. You had to figure it out ahead of time to buy stocks just before all of a sudden people started to recognize that his hawkishness was more just posturing. You can't figure it out.
Well, because he doesn't know what he's going to do in 15 days from now.
That's true.
I mean, he's going to look at the data when the meeting comes and make the decision at the meeting.
That's true.
He's not going to tell you today what he's going to do 3 days, 5 days, 7 days, 2 weeks.
And if he doesn't even know what's going to happen, where he's going to go, how are we as investors? And that's why when I'm talking about here is why you don't try to time the market and try to get out or get in when you think it's going to go up or make changes like that. It's because the Fed can't even figure it out. How are we going to figure it out? So I just thought that would be just an instructive little piece right there, just talking a little bit about Federal Reserves, how does it affect things? Because I've had that question a lot, quite frankly. An email. People say, Paul, I hear about this. And I'm saying, and they say, what do I do? I heard this. And I got this email. And I can't tell you how many times I've had to say, hit unsubscribe.
I told somebody, just turn on reruns of Happy Days.
Anything. Just hit unsubscribe. Because, and one of the recent ones I just got, I said, did you read the fine print? No. I said, do you see who put that out? No. And they said the dollar's going to crash. I said, did you see? And they said, no. I said, they were selling gold. And because the dollar's going to crash, they want your dollars for their gold.
You had said something at the beginning of the segment about, Trump saying we'll just sell some national assets. If they were to take over every company in the S&P 500 and sell them, they could pay off the national debt.
Well, I don't think that wouldn't be a good idea. No, see, you think about it, that's not going to happen.
Right.
Because you're killing the goose that lays the golden eggs.
Right.
You look at where the money comes from and you just go like, okay, and I know it's an overused metaphor. The golden goose, or the goose, that lays the golden egg. But it would be like going, whatever. We've got this machine that produces, some cars or something like that. Hey, you know what? Let's just destroy the machine that's producing the cars and go, well, what happened? How do we produce cars? Well, who cares? I mean, it would be ridiculous. You're not going to fix the problem.
It would be all right if it was electric cars.
That's terrible. All right. Listening to the Investor Coaching Show. You don't want me coming up with metaphors on the fly. It's just apparently it just doesn't work.